Good afternoon to Real Talk Economics, the June edition. My name is Markus Kuger, and I'm the Chief Economic Advisor at Baker Ring. For those of you that don't know us, we are a global accounts receivables management company. Let me put up the slides, and today I want to talk about why business failures are becoming more common at the moment. For those of you that are joining us for the first time, let me run you through the agenda. It follows a usual pattern. I want to start with macroeconomic conditions. Then I will talk about geopolitical developments, and there are some good news here. Risk levels are not as high as they were a month ago. Still nothing to be too excited about. They're still fairly elevated, but compared with the May edition of Real Talk Economics, things have improved. Chapter 3 and 4 are closely connected, I'd say. I want to talk about credit risk trends, business failures, payments performance, and then our special topic for today is the recently released payment study 2025 from Dun & Bradstreet. Before I joined Baker Ring 4 years ago, I was working for the country insight team at D&B. I had been with them for 11 years, and I always valued this publication because it contains B2B payment performance information for almost 40 countries. There is a sectoral breakdown in it as well. There's breakdown by company size as well. It's free of charge. It has been released a week or two ago. You should be able to find it online. If not, please feel free to reach out to me and I will point you in the right direction. Last topic of the day, last chapter is Q&A. If you have questions, if you have comments, please use the comments function here on LinkedIn and I will address your questions towards the end of today's event. Let's start with macroeconomic conditions and let's begin with high frequency data. As mentioned, certain economic indicators have improved in recent weeks, and one of them is the stock market, especially in the US. The S&P 500, left-hand side here, has recovered almost all of its losses that it has seen since April. We're still not back to the levels recorded in June and in January and February, but things are looking better. So stock markets around the globe, positive developments there. The US dollar, however, remains weak. It hasn't recovered from the shock that occurred in early April when Donald Trump announced all these tariffs. In fact, the dollar is on a 3-year low against the euro, and it's also on a 3-year low against the British pound. So no changes here. That seems to be a persistent trend at the moment. Consumer confidence, not a lot of change to report on here. When we look at the US, this is the University of Michigan's Consumer Sentiment Index. You can see that it has been falling for quite some time, basically since the end of 2024. This indicator has been on a downward trend, and that is quite problematic given the importance of the US as a global market. This isn't good news. Admittedly, some consumer confidence indices, for example, the Conference Board's consumer confidence indicator, different measure, has started to show improvements. But even despite that improvement, the consumer confidence readings in the US are still down from late 2024. So in a nutshell, American consumers have become more pessimistic since the start of the year. And despite a potential recovery at the moment, we're still nowhere near the level seen in 2024. Let's jump across the Atlantic and look at the corresponding EU reading. Consumer confidence in the EU has been following a similar pattern, has been falling since late 2024, has been falling in early 2025, but positively, and you can see that by looking at the right-hand side, it has recovered in its latest data point, but you can also see we are still below the long-term average. In the UK, similar picture. We've seen some deteriorations in 2024. They happened a bit earlier in the UK around the autumn budget. And since then, it has been moving sideways more or less. The May reading shows a modest improvement, but you can also see that we're still in negative territory, which means there are more pessimistic households than there are optimistic households. And by looking at the UK reading, the EU reading, the US reading, you can see that, generally speaking, consumers around the globe, they are holding on to their money, especially spending on big ticket items is unlikely to go up anytime soon. So companies targeting the B2C market, they will continue to face some constraints. Let's look at the business side of things, and let's start with the US again. And I've mentioned earlier that certain indicators have improved, and business confidence in the US is actually one of these indicators. The Purchasing Managers Index has shown or is showing improvement in May. For those of you not familiar with PMI, PMI stands for Purchasing Managers Index. The range is between 0 and 100. 100 is the best reading, 0 is the worst reading, 50 is a neutral line, hence readings above 50 are good, readings below 50 are bad. When we look at the Composite Output Index, composite meaning combination of manufacturing and service sectors, we can see that the index has increased from 50.6 points in April to now 52.1 points. It's a 2-month high. It's not a multi-year high. It's simply the best reading in 2 months, but it is up from the April reading, which is positive news. When we look at the service sector in particular, the index has improved by 1.5 points and now stands at 52.3 points. So it's above that crucial 50 points line. Manufacturing has also improved. It stood at 49.6 points in April, so below that neutral line, and is now on 50.7 points, the best reading in 3 months. However, it doesn't mean that everything's fine from a PMI perspective in the US. If you drill deeper and look at the different sub-indices, you can actually see ongoing weaknesses. For example, export orders, they continue to fall. Prices are still increasing. Input prices, that is, they are still increasing. That's putting some pressure on margins. And supply chain stress is also becoming a bigger problem again. And then there is one sub-index that is noteworthy in particular, and that is the inventories sub-index. And the inventory sub-index is exploding. It's rising by the fastest pace ever recorded. And why is that? Well, it's a safeguard against higher tariffs. American companies are stockpiling input products at the moment. Inventories are going up, and that is because companies are concerned that these input goods will become more expensive going forward as these tariffs are coming in. When we look at the Eurozone, unfortunately, things haven't improved. Quite the opposite. Things have deteriorated. Eurozone companies have become more pessimistic. In May, the Composite Output Index has fallen from 50.4 points in April to now 49.5 points. So it has dropped into contraction territory. It has fallen below 50 and is now actually on the worst reading in half a year. The service sector has seen a drop by 1.2 points, now standing at 48.9 points. It's the worst reading in 16 months, so that's quite noteworthy, I think. Manufacturing hasn't moved. Manufacturing is unchanged in growth territory, 51.5 points. But service sector not looking good in the Eurozone at the moment. When we look at the composite new order inflow, so combining services and manufacturing again, we can see that the new order inflow has been falling for 12 consecutive months now. And there is a sub-index in the PMI asking survey participants whether they are optimistic that the next 12 months will be better than the last 12 months. And unfortunately, this business optimism sub-index that has moved lower, and that was mainly driven by the service sector. In fact, the service sector is now on the second weakest reading since 2012, if you ignore COVID years, because they were quite distorted. So Eurozone service companies are quite pessimistic about the year ahead. When we look at UK business confidence, the service sector has seen an improvement, while the manufacturing sector has seen a further deterioration coming from an already low level, that is. On balance, composite output index, or composite meaning combination of manufacturing and services, that has increased, in fact, from 48.5 points to 49.4, best reading in 2 months. Service sector has driven that up by 1.2 points to 50.2 points. So services in the UK are in growth territory again. Difficult to draw a trend from one data point, but at least that's good news. But the problem is obviously manufacturing. Manufacturing PMI has lost another point and now stands at 44.8 points, which is very, very low. In fact, it is the worst reading in more than 1.5 years. New order inflow, similar to developments in the Eurozone, has been falling, and it has been falling by the fastest pace in 2.5 years. So that shows that there will be some pipeline problems going forward. At the same time, however, business optimism has increased. Not sure why that is, because if new orders are falling, I'm not sure why you're optimistic about the future, but business optimism has increased to a 5-month high, and that was driven by the UK service sector. Let's change the angle a bit and look at inflation. If you had joined us last month, you might remember that I said inflation isn't a problem anymore, and I still stick to that statement. Unfortunately, it's not true when you look at UK data. In the UK, inflation is becoming an issue again, obviously not to a degree that we've seen in 2022 and 2023. Have a look at the chart on the left-hand side. Inflation was very, very elevated then. But you can also see that inflation has been moving higher for more than half a year now. Since September 2024, inflation rates in the UK have been rising again. In April, CPI, consumer price inflation, came in at 3.5%, and CPIH, consumer price inflation plus housing costs, came in at 4.1%. The Bank of England's inflation target stands at 2%, just to keep that in mind. So we are quite significantly above that Bank of England's inflation target. Why is inflation so high? But the key drivers at the moment are education, housing and household services, and communication. Prices there are rising quite quickly, and generally it's the service sector where inflation is more pronounced. Service sector inflation in the UK, 5.8%, goods inflation below 2%, 1.7%. That's not UK specific. We're seeing that in many markets, but inflation at the moment is a service sector driven inflation. In other geographies, inflation isn't a problem. In fact, in the EU, inflation has dropped to 1.9% yesterday. So it's below the 2% target for the first time in quite some time again. In the US, it's not a problem either at the moment, 2.3%. But of course, it will depend on the tariffs that might or might not come. If tariffs are implemented, inflation in the US will move higher. Also a problem in the US is inflation expectations. Inflation expectations are too high. Markets expect inflation of around 4% in 12 months' time. Keep in mind, 2% is inflation target. And the problem with inflation expectations is that it can be a self-fulfilling prophecy. So if you expect inflation to be high, inflation will be high. At the moment, 4% is not that far away from 2%, but it is certainly something that the Bank of England needs to be concerned about. And because inflation has been on an upward trend and inflation expectations are not that well anchored, the Bank of England's room to maneuver is certainly smaller than the ECB's room to maneuver, for example. Which brings us to interest rates. Interest rates have come down around the globe. We can see that by looking at the chart on the left-hand side. This shows you the interest rate on new corporate loans in the Eurozone. Could have shown you the corresponding UK reading, would have followed a similar pattern. It would be higher because the interest rates conducted by the Bank of England weren't as aggressive as in the Eurozone, but interest rates have come down around the globe because inflation has moderated from the levels seen in 2022 and 2023. In the UK, the Bank of England has cut rates from 5.25% in mid-2024 to now 4.25%, and markets expect at least another interest rate cut before the end of the year. Sometimes 2 interest rate cuts could be are expected by market watchers. The problem with the recent interest rate cuts is that despite them, interest rate levels are still far above the levels seen 5 years ago or 10 years ago. You can see that by looking at the chart on the left-hand side. So if you're rolling over a loan that you've taken out 5 years ago or 10 years ago, you're facing a much higher interest rate bill. And that applies to both consumers as well as companies. And there's an additional problem, and that is lending conditions. Lending conditions have tightened. And when you look at the Q2 2025 credit condition survey that the Bank of England has recently published, you can also see that commercial banks expect more failures in the corporate sector in the UK. And that doesn't bode well. It probably means that lending terms will tighten further. So accessing credit is still complicated. This is a new slide. I've included it because I've realized that my presentations tend to be overly pessimistic. So I just wanted to pick a few data series that still look promising, and the labor market is a good choice. Here we're looking at 4 different parameters of the UK labor market. I could have picked the Eurozone or the EU, would have been a similar story. The labor market is still in reasonably good shape. Let's start at the top left, shows job vacancies. Job vacancies dropped immensely during COVID. Lockdowns were implemented. So the number of open positions fell, and then it skyrocketed in the aftermath of COVID, reached a new all-time high. And for the past 2 to 3 years, it has been falling again, and we're roughly to where we were before COVID. So job vacancies are still looking good in the meaning of it's not as difficult as it was 3 years ago for companies to find workers, but there's still a decent amount of jobs out there that are not filled. When you look at the employment rate on the top right, we can see that COVID had an impact. It dropped during COVID and has moved sideways since then. So employment levels are lower than before COVID, but they're higher than they were 10 years ago. So it's a bit of a mixed bag. Unemployment rate, similar analysis. Unemployment had been falling quite quickly up until COVID. Then COVID came. We're looking at the bottom left here, by the way. COVID came. We see that spike, and then it dropped again. But for the past year or two, unemployment has been rising again. But despite that increase, it still stands at 4.5%, which is an unemployment rate that isn't concerning. In fact, it is very close to that full unemployment definition that economists are using. For us, an unemployment rate of 4% means full employment is reached. Real wage growth at the bottom right is probably the most volatile chart here. It goes up and down, and that is mainly driven by inflation, because real wage growth is calculated by looking at nominal wage growth minus the inflation rate. And because inflation was so high in 2022 and 2023, real wages actually fell. Now inflation has moderated, at least compared with 2022, and nominal wage growth is still substantial. Workers are in a good position to ask for pay rises. They're still getting compensated for the losses occurred in 2022 and 2023. So wage growth is fairly substantial, currently at around 1.8% in the UK. That's not high when you compare it with the COVID years. They were heavily distorted. But if you ignore COVID, real wage growth at the moment is actually on the highest reading in a decade. So if you're complaining about your salary, you should keep in mind that UK average, it looks okay at the moment. 1.8% real wage growth is a rather good figure, at least if you compare the last 10 years and you ignore COVID. This slide hasn't changed from last month's presentation. That's because real GDP growth projections don't change that often. And the IMF has only just revised them downwards in April when they released their latest World Economic Outlook. Let's start at the left here in that light blue box. The world growth forecast stands at 2.8%. That's not a great figure. It's down from last year, and 3.3% wasn't a good figure in the first place. Normally, global growth is higher, tends to be around 4%, even above 4%. So global growth has come down already, and now the IMF has carried out a downward revision. Up until April, the IMF had forecasted global growth of around 3.2%. So we went down from 3.2% to 2.8%. And that's because of several downward revisions to major economies, most notably the US. The US has seen a sizable downgrade to its 2025 growth forecast in April. Figures dropped from 2.7% to now 1.8%. China has seen some downward revisions though as well. Eurozone growth was revised downwards from 1.2% to 0.8%. The UK growth forecast for this year currently stands at 1.2%, and that's down from a previous forecast of 1.7%. So in a comparison, the UK has seen a sizable downward revision from 1.7 to 1.2, but it will still grow faster than the Eurozone. Eurozone growth for this year is penciled in at 0.8%. But the problem is that the situation is very fluid, and I'm sure in the next World Economic Outlook update, which is due in July, figures will change again because a lot of it is driven by geopolitical developments and the trade war in particular. So if you joined last month, you will remember this slide. It hasn't really changed. We're looking at the Economic Policy Uncertainty Index, which is a concept that measures certain keywords in major publications around the globe, and then it gets weighted by real GDP of a certain country. And by looking at the last 7 years, you can see a spike during the first wave of COVID, and then things normalized again. And then Donald Trump returned to the White House in January 2025. And since then, economic policy uncertainty is rising quickly again, and it hasn't moderated yet. Where we can see a moderation is when we look at the Trade Policy Uncertainty Index, and that's one of the metrics that has improved over the past months. Similar logic here, tracking certain keywords in major publications such as the Financial Times, Wall Street Journal, the Times, and so on and so on. And you can see in April, when Donald Trump made these tariff announcements, Liberation Day, as he called it, the index exploded, and subsequently Donald Trump granted an extension, and these measures weren't immediately implemented, and trade policy uncertainty has fallen again. But when you look at the overall level, it's still very, very elevated compared with a year ago or 5 years ago. So it is still a major problem for companies around the globe. And just because these tariffs haven't been implemented yet doesn't mean that there is no trade war going on. Tariffs have increased compared with a year ago. In fact, today, tariffs for steel and aluminum exports to the US will double from 25% to 50%. The UK isn't included in that because they're currently negotiating a free trade agreement with the US, but other tariffs have risen as well. So dealing with the US has become more complicated, and it has become much more uncertain, and that isn't good news for companies. So the trade war is still going on, maybe not to a degree that we've seen a month ago, but the deadline that has been extended by Donald Trump, companies were given a 90-day grace period that is expiring in a few weeks' time, and we don't know what will happen then. Will they be extended again? Will these tariffs be phased in? So a lot of uncertainty around the globe, and that is not good news for economics. Before we move on to the credit risk chapter, let me remind you that you can submit questions via the comments function here on LinkedIn. So if you have questions, if you have comments, please use this function and I will address them towards the end of today's event. Credit risk, still a major problem around the globe. We're looking at Europe here, but it is a global phenomenon as well. Business failures in Europe, they're still elevated. We start with England and Wales on the left-hand side. England and Wales had an encouraging 2024, I'd say. Figures fell by 5%. That's the good news. The bad news is that they fell from a 30-year high in 2023. And the bad news is also that business failures in England and Wales, they started to increase again in Q1. Figures went up by more than 3% year on year. On the right-hand side, we are looking at the registration of businesses, which is the blue line in that chart. We ignore that. It's not important for our analysis today. Let's focus on the yellow line, which shows the declarations of bankruptcies in the EU. And when you approach it from an annual perspective, you would see that figures in the EU increased by 4% last year. But there are some positive developments here. As you can see by looking at the right-hand side of that chart, it peaked in Q3. That yellow line peaks in Q3 2024. Since then, it has been on a downward trend. And in Q1, compared against Q1 2024, figures actually decreased by 1.5%. So could be that the tide is turning in Europe. It's too early to make a call here, but there's one major problem, and you can simply see that by looking at the chart again. Insolvency levels, it's an index. So the higher it is, the more insolvencies, and you can see that insolvency levels are higher at the moment than they were before COVID. Of course, they're higher than the lockdown years because of some state support, government support, temporary suspension of insolvency regulations. But compared with the pre-COVID years, insolvency levels in the EU are up as well. Widening the analysis a bit and looking at global developments here, insolvency figures have risen in most countries over the past 2 years. And Allianz Trade, they are publishing a global insolvency index, and that has actually increased by 10% in 2024. And problematically, the index is 10 to 15% above the reading before COVID. So compared with the 2016 to 2019 average, the global insolvency index has risen by 10 to 15%. What's the outlook? Well, typically as an economist, I will tell you on the one hand, on the other hand. On the one hand, interest rates will come down. That should help. On the other hand, however, growth is lackluster. Lending conditions are tight. So I put my money on more business failures this year. And in fact, that's also what Allianz Trade's forecasting. They expect another 6% increase this year, followed by a 3% increase next year. Payments performance in Europe. This is data from Dun & Bradstreet for several European economies. And we're looking at B2B data here. And we're looking at the average payment delay in days in the first quarter of 2025. Before we talk about the first quarter of 2025, let's look back at 2024. It has been rather uneventful. Payments performance in Europe hasn't really changed on an average level here. Payment delays have lengthened by 0.1 days from 12.1 days to 12.2 days at the end of 2024. So that's not sure if you want to call that good news because payment delays have lengthened, but at least it hasn't really changed a lot. However, when we look at the first quarter of 2025, things look more concerning because data for January to March actually shows that the average payment delay in Europe has increased from 12.2 days to now 12.7 days. In the UK, delays went up from 10.8 days to 12.2 days, which is not a good development if you work in credit risk. And in France, which has been a country to watch anyway, there was another deterioration, and that is just maintaining a trend that has started several years ago. In fact, average payment delays in France, they have risen from around 12 and a half days before COVID to now 17.7 days. France is the second riskiest country in that comparison, which is something that I would have never thought would happen when I started working with their data in 2010 when I joined Dun & Bradstreet. Generally speaking, and maybe that's a good reminder for those of you that have missed last month's webinar, Bakering and Dun & Bradstreet hosted a webinar last month, which is available on the Bakering homepage, where we talked about how you can minimize your exposure risks to slow payers, what products D&B is offering in that field. Lisa Baker, the founder and CEO of Bakering, was speaking about collection practices. So if you have missed the webinar and want to watch it, please have a look at the Bakering homepage. And that brings us to the last chapter of the day before we reach Q&A. Again, if you have questions, use the comments function. And we will talk about the payment study that has just been released by Dun & Bradstreet and its worldwide network partners. As mentioned previously, 39 countries are covered. And we're looking at the share of prompt payments in the country, the share of payments that are made significantly late, 90 days and more late. We're looking at certain sectors, we're looking at company sizes. So it's a very detailed study that is produced once a year. And I've been working with it for 15 years. If you want to have a look, I'm sure you can find it on the internet, and if not, please reach out to me and I will point you in the right direction. So 39 countries are included. I'm only looking at the European ones. 26 European countries are included, and it's broken down into Northern Europe and Southern Europe. And we start with Southern Europe. So what are we looking at here? We're looking at B2B payments performance in Southern Europe last year. The blue bar represents the prompt payments, and the orange bar represents payments that are made 90 days late, 90 or more days late, and it's measured as a share of total payments. So in other words, blue is good, prompt payments, low credit risk. Orange is bad because it means invoices haven't been settled within 3 months. And the high-risk countries are on the left-hand side of this chart. Romania, Portugal, Bulgaria, the share of prompt payment is below 20% of all payments. That's not good news. In fact, in Romania, there are more 90 days overdue payments than there are prompt payments. I think that's rather concerning. The data is from Dun & Bradstreet's proprietary trade program, actually, and that's something that Lisa mentioned in the webinar last month. We at Bakering, we encourage our clients to participate in Dun & Bradstreet's trade exchange program because it is a good way to incentivize your customers. If your customers pay you quickly, then let a credit referencing agency know about it because it will give them a good credit score. However, if your customers are not paying quickly, also let the credit referencing agency know, because that might incentivize your customer to pay quicker in future. Pay you quicker, but also pay other companies quicker. So back to our data here. As you can see, there are certain countries where the share of late payments is very, very high. Romania, 16% of payments that hadn't been settled within 90 days. Greece, 16%, but even France, look at France, 6% of all payments that haven't been made within 90 days of its due date. So that is rather concerning. Hungary, at the other end of the spectrum, fairly good payments performance, almost 74% of all payments are made prompt. But generally, you see a lot of orange in here, and orange is bad, orange is high risk. And when we flick onto the next slide, we can see the Northern European payments performance. And here we can see that orange has pretty much disappeared. There are a few countries where there is still a orange bar visible, but compared with the Southern European region, the payments performance is much better. That doesn't mean that everything is fine. Belgium is on a bad trajectory. Luxembourg, not looking good. The UK is somewhere in the middle. Around 59% of all invoices are paid on time. That's not too bad. But the sweet spot is obviously Denmark with 94% prompt payments and 0.1% of invoices that haven't been paid within 3 months. So if your customers sit in Denmark, that's probably a very low risk candidate. Here on this chart, might be too small to look at it, but again, download the report free of charge. We can see the changes in payments performance over the past 2 years. Select the countries you're the most interested in. There are a few countries that have seen significant deteriorations. Belgium is one of them. But then the share of prompt payments in the UK as well as in Ireland has actually risen quite substantially over the past 1 year, 2 years. So winners and losers, as always, have a look. I'm sure you will find the country you're the most interested in. And this breakdown exists for several more regions as well. It's not limited to Europe. When we look at the UK, we can have a look at the sectoral breakdown here as well. And I like this chart because it shows that construction is paying quickly. UK construction, 70% prompt payments here. Less than 2% of invoices have not been paid within 90 days. But does that mean that credit risk in UK construction is low? From a payments performance perspective, potentially. But then when you look at business failures, the picture changes very, very dramatically. 20% of all business failures in the UK occur in construction. So in construction, you might get paid quickly, or you might not get paid at all because the company goes bust. So it just shows that looking at one metric isn't enough to assess credit risk in an adequate way. When you download the report, you will also see the 5 sectors in each country that have shown the biggest deterioration over the past 12 months. In the UK's case, there isn't a single sector that is paying slower compared with 2023. All subsectors have shown improving payment patterns. So this worst performer chart is still a worst performer chart, but it just shows the countries or the sectors that improved the least. And by looking at these 5 sectors here, you can see that it has been extractive industries, petroleum and coal, minerals. So things are not looking are not improving as quickly as in other sectors, but they're still improving. I think this is the main message here. Before we reach Q&A, and again, if you have questions, please feel free to submit them. Let me sum things up for you. What are the key takeaways today? First of all, 2025 growth will be weak. That's not new. I've told you last time. I've told you in March. I've told you in February. I think I've been telling you this message for many quarters. And unfortunately, the risks are skewed firmly to the downside. The likelihood that growth forecasts are revised downwards is bigger than that they will be revised upwards. The likelihood of a global trade war has eased. It doesn't mean that there is no risk at all. Trade barriers have certainly gone up. For tariffs for steel and aluminium have doubled today if you're trading with the US, for example, and that has only been announced a few days ago. So it's impossible to prepare for that, and trade barriers are an important topic and will remain an important topic. Just because these tariffs that had been announced in early April haven't been implemented yet doesn't mean that they are not coming. And these elevated uncertainty levels, they are rather concerning because they impact adversely on investment decisions and they also weigh on household consumption. Inflation is rising in the UK against the regional trend, but that doesn't mean that the Bank of England will increase interest rates anytime soon. Quite the opposite. I still think that interest rates in the UK will continue to fall, not as aggressively as initially hoped, not as quickly as in the Eurozone, but the Bank of England will lower interest rates in the second half of the year, 25 basis points, maybe 50 basis points. But that doesn't mean that credit risk will disappear. Quite the opposite. I think it will remain elevated in the second half of 2025 going into next year. Lending conditions are tight. Interest rates are still elevated compared with 5 years ago or 10 years ago. And geopolitical risk remains a problem as well. Payments performance has deteriorated in Q1. At least that's what the most recent DNB data is showing. There are winners and losers, but the UK, unfortunately, showed a deteriorating payments performance in Q1 for the first time in many moons. So whether this will continue into Q2, we shall see. But 2025 wasn't off to a good start. And if you haven't done so yet, I'd strongly encourage you to have a look at the payment study that Dun & Bradstreet has released recently together with its worldwide network partners, because it is an excellent piece of information if you work in a credit risk function, because it gives you a kind of an overall picture. Of course, it doesn't include company level information, but at least it shows you national trends. It shows you sectoral trends within a geography. So, and unfortunately, or not unfortunately, but as expected, there are wide disparities amongst the 27 or 26 European countries that are covered. Before we start with Q&A, let me also remind you that if you need additional help to navigate these still very turbulent economic times, please have a look at the Credit Hubs section on bakering.global. You will find more macroeconomic, geopolitical risk focused reports. You will find content about sectoral performances, and there is also an area that holds country fact sheets where we talk about collection practices, where we look at the legal terms or the legal environment, the usual terms in the country written by credit professionals for credit professionals, and all of that is free of charge. I'd also invite you to connect with me on LinkedIn if you haven't done so yet. I'd also invite you to follow Bakering on LinkedIn, sign up for our weekly newsletter to stay informed about these developments. You can sign up for an alert to be notified about upcoming events. And yeah, that's all I wanted to cover today. Looking at the questions, there is one question about Germany again, my home country. We covered it in depth last time. And the question is, that has actually come in before the event was sent to me. You can also do that, by the way, if you want me to address questions on 2nd of July, the date for the next Real Talk Economic session. You can reach out to me already. And that person asked me about investment in Germany. Will it go up? Will it go down? And at the moment, the government is implementing reforms that will make it easier for companies the depreciation of machinery investment will be easier. So companies can benefit from more investment at the moment from a tax perspective. So that should have a beneficial effect. But unfortunately, the measures that will be implemented by the government, they're fairly limited. It's not a big bazooka. It's not sure if it will be a game changer. Honestly, I don't think it will be from a corporate investment perspective. I think the bigger impact will come from public investment. The government has massively increased its government debt load. So on the one hand, that's obviously negative because this debt needs to be serviced. But then on the other hand, the government will use that money to invest heavily in the army, will invest heavily in digital infrastructure. Germany is a nightmare when it comes to that. And it will also be used for improving physical infrastructure. Railroad in Germany if you have traveled on a German train in recent years, I'm sure you will know what I'm talking about. Roads, bridges in particular, are crumbling. So investment will go up in Germany, but that's probably mainly driven by public investment, not so much by the corporate sector. And the housing market in Germany has been weak for quite some time, partially caused by self-inflicted errors. The previous government has made it very difficult to install new heating, for example. There's a lot of uncertainty whether you can still buy a gas heating or whether it has to be powered by renewable energy. The new government has addressed that. It will take some time, however, until this will be felt in investment rates in Germany. Okay, there are no other questions today, which means we can wrap things up. Gentle reminder, next Real Talk economic session, first Wednesday in July. And I'm looking forward to seeing you all again there. Thank you so much for your attention today. Have a good rest of the day. Bye-bye.